Your mortgage is renewing soon. Here are 5 tips for you to ease the stress and the financial pain in a rising rate environment. Okay, so we're into this interest rate cycle. Interest rates have kept going up, and we've now had a ton of interest rate hikes. And now you're about to renew your mortgage and you're wondering, what the heck do I do? Are we done with interest rate hikes? And if yes, do I renew for a long period of time, a short period of time? What do I do? I'm confused. I don't know. Maybe I don't have the budget to pay for this. So we've come together here today with 5 tips to help you ease that pain. First off, test drive the new mortgage rate. So do a budget. Figure out how much, go to the mortgage rate calculator, figure out how much this new rate is going to cost you. Call your bank, get a rate, plug it into the mortgage rate calculator, and figure out what your new mortgage rate payment is going to be if all things stay the same. If you renew for 5 years, what would your payment be? Once you have that number, try it out for a month or two. Before renewing, try it out. Can you tighten the belt anywhere? Are you able to, save on a few coffees here or there? Does the budget still work? Are you able to afford that on a monthly basis? By test driving the rate, you're going to have an idea ahead of time so you don't have that huge stress when you're faced with that renewal. Option 2, lengthen the mortgage amortization period. Now, this is not something most people want to do, but if you're really faced with no other options, ask your bank if they do a 30, a 35, a 40, even a 50-year mortgage. Now, depending on where you live in Canada, they may allow that, they may not. I know in the prairies it's kind of frowned upon, but in the larger cities, they love that kind of stuff. By having a longer amortization period, you're basically paying less of your debt on a monthly basis. You're paying less of the principal down. You're paying the same amount of interest, but less of the principal, which makes the mortgage payments more manageable. The downside, obviously, is you're going to pay debt for a much longer time. My advice to you, only do this if it's the only possible way you can survive. Like if it's between this and not feeding your kids, do it. And if you're going to do it, obviously, make sure to review this when your mortgage comes up in 1, 3, or 5 years, and make sure to look at the strategy. And now you should perhaps go back to a shorter amortization period. If interest rates come back down, like many expect they will over the next 2, 3, 5 years, and we get back to a 2-3% range, you need to be able to go back to that shorter period so that you're not paying debt until your 80s or 90s, or in fact, saddling your kids with that debt when you pass away. This should only be used as a temporary measure to alleviate the pain in a high interest rate cycle, not as a permanent solution to the cost of borrowing. Another point to note is if you decide to do this, to lengthen the mortgage period, the amortization period, they're going to make you pass the stress test again. And banks will typically use a much higher rate than the current rate in order to see if you're able to pay this mortgage down. So they're going to use industry norms and industry comparables, and they're going to use a much higher interest rate, maybe 7, 8, maybe even 8.5%, to see if you are a candidate for longer amortization period. Option 3, get a rate hold and then perhaps break that mortgage if it's in your better interest. A lot of banks will allow you to request a rate hold for a period of time. So you could say, I'm thinking of renewing the mortgage. They will quote you a rate and they will lock that in for a period of time, 60 days, 90, maybe even 120 days, meaning that you can get guaranteed access to that rate even if rates increase. What that does is if we get into a position where the Canadian Central Bank is increasing interest rates, it'll allow you to lock in a rate that's much lower, even if you have to pay a penalty. It gives you that option. It gives you that added flexibility, which you may not need if interest rates don't go up. But if they do go up and you're close to the maturity date of your payment, you'll be able to perhaps blend it or to break the mortgage and still be ahead considering that interest rates went up. 4th option, look at renewing at a shorter term or for a shorter period of time with the hope and expectation that interest rates are going to come down. So instead of locking in for 5 years or longer, look at a 2 or a 3-year mortgage, because that might be the sweet spot where banks are bringing interest rates back down when the central bank moves. So again, don't take this as mortgage advice, but consider that as an option for you if you're not sure what to do. Talk to your investment advisor, your professional, and get that advice. And if you'd like to book a no obligation consultation with us to chat about this, go to www.speaktorob.com to book a no obligation chat. We'd love to chat with you about this or how your investments are doing to support this newer kind of increased cost of living for you. Finally, number 5, and this is the toughest one, tighten the belt. If there's no other way for you to make the payments work, if you can't get a longer period of time to amortize the mortgage, if you're not able to renew, if you can't lock in a low rate, if you have no other options, look at either getting some equity from somewhere else in your life to help fund those mortgage payments, or if all else fails, you're gonna have to tighten your belt in order to pay that mortgage. You could borrow from Bank of Mom and Dad if that's an option. If that's not an option, look at your budget, print out a budget, figure out where you're spending your money, and start cutting. I know that's not what you want to hear, but if all else fails, that might be your only option. And I know it's not pleasant, but it's likely only going to last for a few years while interest rates kind of get back to normal and we start seeing the central banks ease off on the interest rate increases and start talking about decreasing interest rates. Don't forget to like, subscribe, guys. Thanks for tuning in. I'm Rob Tetrault. I'll see you in the next video.